who really want to be in the parts of the market that are going to be benefiting from government support or positive government action. So the larger dynamic, of course, is that we've got concerns about the external side of China. From an index perspective, I think it's important to note that only 2% of MSCI China index revenues directly come from external revenues from the United States. So the direct effect of tariffs is actually not that great. Of course, the second order effect, which is how does the domestic economy respond and how does the supply chain respond to that is very important. We've taken our numbers for MSCI China down. We're below consensus, but we think that where you want to be within the market would be the parts of the market, for example, consumer-oriented areas that will benefit from government stimulus. So our four key strategies within China are, number one, the consumer stocks, which I just mentioned, which would benefit from government stimulus. Number two, we like the various parts of the AI chain, as we discussed in a previous segment of this program. Number three, we like the idea of Chinese companies that are selling to emerging markets and therefore not in the crosshairs of tariffs and where they're gaining market share. And number four, which is a really nice theme which we like, which is low beta and is much more sort of so-called alpha in it, is the idea of companies returning cash to shareholders. There's a very strong move to increase both dividend payments as well as stock buybacks. And that's a low beta theme which gives you high current yield in a much more volatile aggregate market environment. So those are four areas that we particularly like within the China market.
Yeah, so the value up in China definitely not getting enough headlines, I would imagine, I would think, at least compared to South Korea's or Japan's. So yes, definitely worth a mention there. In terms of a stimulus, and I know that we've been talking about this for so long, and we've been getting that, but it's this really drip feed approach that is making things very difficult for a lot of China watchers and investors. You know, when do I get in? Do I get in now? Do I wait for more signals? I mean, how do you think should the approach be here when it comes to stimulus, the PBOC put?
Sure, Sherry. So I think the answer is pretty clear that people who are expecting the so-called proverbial bazooka are going to be disappointed because the government has clearly signaled it will not move in that way. The way to think about it is really cushioning downside risk or so-called left-tailed risk. So when the economy is weakening, then policy stimulus will be dialed up. And so I really think it's a question of taking out some of the more extreme downside risk to growth and doing so through various modalities, which include consumer support, which we just mentioned, as well as issuing new government, central government debt to repay some provincial government higher cost liabilities, and a few other areas, which maybe include some property support and some of the support for newer 21st century industries that Martin and I and you were talking about previously. So I think really what you want to do is look at where valuations are giving you some cushion in the market, expect and hope that there will be further government support if there's evidence of further weakening the economy, which may well come out in the next couple of months, and really pay attention to the risk-reward entry point. And when the market's oversold, feel that that may be a better opportunity. When it's rallied a lot, maybe being a little bit more cautious on the entry point.
I think you mentioned some of the Chinese companies that we should look at that raise a lot of their revenue earnings from some of these emerging markets as well, and correct me if I'm wrong. But what if these markets, these other trading partners are being asked by the United States to raise barriers to Chinese goods? I mean, it could take some time, but what if that's really the eventual outcome that we end up seeing? Then that could actually hurt these Chinese companies that may not be exposed too much to the United States and the trade war.
That is true, and I think we need to separate the modality of exports from end market demand from reprocessing trade. So I think what the U.S. regulators are going to be very focused on is so-called origin washing, which is where a Chinese good of origin would just go to some other, perhaps Southeast Asian economy, have a bit of added value to it, but not very much, and then just have a label made in X, whether it's Malaysia or Thailand or Vietnam, and then shipped to the United States, and therefore you dodge 145% tariff and you got a much lower one. That, I think, is an end run which authorities will be very much focused on. But if you have a good that's really for domestic consumption, maybe an EV or something which is going to be used in that particular country, then I don't think that falls afoul of that concern about end running. So I think you'd really need to do the more micro analysis to understand, what goods are just transshipment goods versus ones that are end market focused. I think the latter ones would be ones where we would have a greater degree of optimism on.